What's up, guys? Welcome back to another day trading video, and today we're gonna go over another part of my strategy. So I think I want to go over every part of my strategy first. So that means equilibrium, breaker structure. So breaker structure might be next. Inverse fair value gaps. Then what else we have? Draws on liquidity, I think, which is kind of actually this. So and then I'm gonna explain all of that onto the charts. So quickly rebriefing my strategy again. And then we're going to go over other things like candlesticks, other things that don't necessarily have to do with my strategy, but still stuff you need to learn so you can understand the market. So like daily biases, actually one of part of my strategy. So we're going to go over that too. But yeah, so let's go over liquidity. All right. So what is liquidity? Liquidity is high resting orders waiting to be filled. So it's just these big orders waiting to be filled. So big banks can't necessarily just buy them right off the bat right there because it's just too much. It'll spike up. It's just too much. So they wait at certain price levels so those orders can be filled, so they can have a chance, so they can have space between the orders to actually fill those orders. I don't know if I'm explaining it right or wrong, but it's essentially like that. High resting orders waiting to be filled. All right, so where can we find these liquidity? Liquidity is very important. It's what we use so we can use in the trades that we take so that we can win on the trade. All right, I'm gonna explain that real briefly, real quick. All right, where do we find them? We find them at highs and lows where they're clusters of stop and or limit orders at a certain price. So they rest at certain prices. All right, and we're gonna go over where to find them real quick. But hold on. They're at certain prices. So when people get stopped out or get filled into those orders, then big banks use institutional traders like us to get those orders filled so they can now then push the market up to win. And we're gonna ride on them. We're gonna low key ride on the big banks because they're gonna be used for us so that we can catch those winning trades too. If they're winning, we're going to do the exact same thing as well. We're going to win off of them too. The market needs access to those pools so big market movers like banks can place their orders. All right, they need access to them. So that's why they're going to push the price down to those draws on liquidity. I'm going to explain that real quick. So they push the order down to that point so they can buy it back up and win on the trade. Markets tend to go to those areas acting as magnets or draws of liquidity. So we say draws of liquidity because we're drawing that price to that liquidity pool, to that liquidity area. All right, we draw it to us. Banks draw it to that point, then in turn use it to boost it back up. I hope I'm explaining it very simply. And now, where do we find these high resting orders waiting to be filled? You find them at highs and lows, but where specifically? Where exactly? All right, areas to look for are highs and lows, but really use high time frame. So we want to use the high time frames. We want to use the high time frame highs and lows. All right, that means the 5-minute, 15-minute, 1 hour, 4 hour, and a daily. Now, the more further you go, the more stronger it is. I see it be strong, the most strongest on the daily. It is strong on the 4 hour, strong on the 1 hour, and 5-minute, 15 are strong as well. I would have to say the weakest, probably the 1 hour. But still, don't let that discourage you from using the 1 hour. I use the 5-minute, the 15-minute, the 1 hour, the 4 hour, and a daily every single day to see the draws on liquidity. Where can we go? So if the draws on liquidity is at a high and we're at a low, and it's showing my strategy where it hit a low of liquidity and then it breaks structure, equilibrium, then I'm going to use that draw on liquidity at the high where banks wanted to go up high so they can take out people and use it as a sell so they can then in turn sell the market so they can then profit. So I'm going to use that. I know the price wants to go up at that level, so I'm going to long. Boom, I took a one. I took a one. And then once it reaches that liquidity pool, I know there's a lot of people selling. I know there's big banks selling at that area. So I'm gonna use another draw of liquidity a low, once we're at the high, we hit it, a lot of orders have been filled. I'm gonna use that to take a short, so it can go into the low. That's a draw in liquidity, so that in turn I can win on my trade again. All right, it's literally bouncing, but you have to find these high time frame draws in liquidity on the high time frame. That means on the 1 hour. That means on the 5 minute, the 15 minute, 1 hour, 4 hour, and a daily. Use these to find where the best draws in liquidity is. It's very simple to use, very easy to spot, and I'll do it on the computer on another video. But yeah, that is high time frame. That is liquidity, a very important, probably the most important concept. Banks use it, institutional traders, retail traders use it, I use it, you use it, you probably don't even know. So yeah, that is draws of liquidity. Thank you so much for watching, guys. If there's any questions, anything you need me to go over next, I'll try to explain it with the best of my abilities. Just let me know. Please comment, like, subscribe, share with your friends so they can learn how to trade and not. I was gonna say not lose money, but you're definitely gonna lose money. But you can also win it. You can also win it. There's a lot of things you have to understand about trading. I'll probably go over that in the next video. Actually, what is trading? All right, that's it for today's video. I'll see you guys in about 2 days, maybe 1 day after or 2 days. But yeah, peace.